The Reserve Bank of Australia hiked rates for the third consecutive time this year, pushing the cash rate to 4.35%. That should have been the story. It was not. By afternoon trade, the S&P/ASX 200 had climbed 113 points to 8,759, its best single-day performance in weeks. The banks, the very sector that a rate hike is supposed to squeeze through credit losses and slower lending, led the charge. Commonwealth Bank added 2.65% to $177.44. Westpac surged 3.75% to $39.04. NAB was up 3.09%, and A&Z gained 3.17%. Every major lender posted its strongest session since the sell-off began. The RBA's post-meeting statement cited the Middle East conflict as an aggravating factor, noting that sharply higher fuel and commodity prices had added to inflationary pressure. Household spending data from the Australian Bureau of Statistics confirmed the pressure. Spending on transport rose 5.1% in March alone as fuel prices peaked and some households switched to public transit. ANZ's head of economics indicated the bank expected the RBA to pause in June, with August the next live meeting. CBA's chief economist put it plainly, 3 consecutive hikes should be enough to bring inflation down, with rate cuts pushed to 2027. Markets appeared to take that framing and run with it. Energy stocks fell as Brent crude slid back toward $110 a barrel on reports that U.S. President Donald Trump had paused naval escort operations through the Strait of Hormuz as part of efforts toward a peace deal. Woodside Energy dropped 2.35% to $31.94. Oil's retreat paradoxically became fuel for equities. But within that broad body, one stock moved on a completely different logic, a logic that had nothing to do with interest rates, oil, or the Middle East. DigiCo infrastructure REIT surged 23% to $2.90 in a single session. Conventional REIT logic runs like this. More assets equal more income, and more income equals a higher valuation. Selling a major asset should compress the story. DigiCo did the opposite. It sold its CHI-1 facility in Chicago for US $750 million, a 5% premium to its November 2024 purchase price, and the market added hundreds of millions in market capitalization by end of day. The mechanism is not complicated once you see it, but it is easy to miss. DigiCo was not selling because it had to. It was selling because it had already won. The Chicago facility was acquired as a near-term income asset. Once it was sold at a profit, the proceeds could be redeployed into SID1, its Sydney data center development, which management described as the most compelling growth opportunity in its portfolio. Pro forma gearing falls from 36% to 17%. Net debt drops to approximately $500 million. The capital structure becomes lighter and more flexible, exactly what a growth REIT needs when construction costs are rising and interest rates are at 15-year highs. The market was not rewarding DigiCo for selling. It was repricing the company for what comes next. And on the same day, DigiCo's move was not isolated. Infratil, the New Zealand-listed infrastructure investor with a 49.7% stake in CDC data centers, jumped 12% to $11.77 after announcing Australia's largest ever data center contract, a 555-megawatt deal with a U.S. investment-grade customer. Total CDC contracted capacity crossed 1 gigawatt. When fully deployed, that single contracted book is estimated to deliver annualized EBITDA of approximately $2 billion. Infratil CEO noted that Australia's regional stability, competitive build costs, and access to renewable energy were the deciding factors for the client. 2 separate data center announcements, 2 double-digit moves. On the same afternoon, a rate hike dominated the headlines. Here is the condition that makes this logic break. DigiCo's redeployment thesis depends on SID1 reaching completion on time and at cost. Data center construction in Australia is facing the same global supply chain pressures that sent JB Hi-Fi down roughly 6% today. The electronics retailer warned that supplier costs were rising and product shortages were beginning to bite, driven partly by the global data center build-out consuming GPU and power component supply. If SID1 faces cost blowouts or construction delays, the Chicago premium becomes a one-time gain that funded an expensive problem. The re-rating could reverse as fast as it arrived. The last time Australian data center capacity moved this decisively was during the hyperscaler expansion of 2021-2023, when AWS, Microsoft, and Google announced successive major infrastructure commitments to Australian regions. That wave drove a re-rating of listed infrastructure names over 12 to 18 months. CDC's deal is now at comparable scale. 555 megawatts is roughly the annual power consumption of 500,000 Australian homes. The difference this time is the rate environment. In 2021-2023, the RBA cash rate was near zero, and REIT valuations expanded on compressed discount rates. Today, the cash rate sits at 4.35%, with 2 economists publicly flagging the possibility of a 4th hike in August. Rising rates raise the hurdle rate for long-duration infrastructure assets. CDC's contracted EBITDA of NZ dollars $2 billion looks compelling in isolation, but the discount rate applied to that cash flow is materially higher than it was 3 years ago. The continuation case rests on one variable: whether the U.S. investment-grade customer at the center of CDC's 555 megawatt deal represents one of many or one of a few. If hyperscaler demand for Australian sovereign jurisdiction compute continues at this pace, DigiCo's Psi-1 pivot and CDC's 1 gigawatt milestone are the opening of a longer structural trend that rate hikes alone cannot stop. The RBA's 4.35% cash rate was irrelevant to today's data center pricing. A tenant who needs Australian sovereign infrastructure does not switch to Singapore because rates went up 25 basis points. The breakdown case is also concrete. If Brent crude stabilizes or falls further and the Middle East situation de-escalates, the RBA may pause in June as most economists expect. That would reduce urgency around the rate pain trade, the same trade that drove banks higher today despite the hike. A pause scenario could also prompt a rotation back into growth names that sold off hardest during the hiking cycle, compressing the relative outperformance of capital-light infrastructure plays. Watch the Infratil share price at the open tomorrow. At $11.77, it is pricing in continued CDC execution. If it gives back more than 3% on no new news, the market is second-guessing the contract timeline. If it holds, the 1 gigawatt story has legs. The benchmark to watch on the DigiCo side is the Psi-1 construction update expected in the next quarterly disclosure. Any mention of cost or timeline revision against the Chicago proceeds will be the first signal of whether today's re-rating was a repricing or a relief rally. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.